Welcome to this explainer. Let's dive right in, because right now we're sitting in the middle of one of the absolute most fascinating paradoxes in modern economic history. Seriously, if you look at how consumers are actually feeling on the ground right now in 2026, it looks like a complete disaster. But if you look at the stock market screens, man, it is a bright, sunny day. We are literally looking at a tale of two completely different realities.
Just think about this number for a second. 44.8. This is the latest print from the University of Michigan's Consumer Sentiment Index. And to really put that into perspective, you have to understand that this is the lowest reading since the survey began all the way back in 1952. Think about that. It's lower than the 2008 financial crash. It's lower than the massive stagflation of 1980. It's even lower than the oil shock lows we saw in 2022. The creators of this survey originally assumed a healthy economy couldn't even drop below the low 50s, and yet here we are, sitting at 44.8.
But then, on the exact same day, we get a VIX print of 17.70. Now, the VIX is essentially the market's fear gauge, and a 17.70 is, well, it's completely boring. It's right smack in the middle of a totally normal, calm range. Oh, and in that very same week, the S&P 500 hit an all-time high. No big deal, right? This brilliantly illustrates the massive contradiction we're exploring today. On one hand, Main Street is practically pricing in a disaster, literally the worst environment on record. Wall Street, meanwhile, they're pricing in a completely normal, maybe mildly volatile, but generally healthy expansion.
So, what does this all mean? Well, both of these readings simply cannot be right. One of them is definitely wrong. And the whole point of our macro radar today is to figure out exactly which one it is before the broader market catches on. We're going to use this explainer as a sort of detective toolkit. We'll walk through 4 specific live macro signals from this week that serious investors are actually watching to solve this exact mystery.
All right, let's start with signal 1, the inflation chain.
We really need to follow this chain because this isn't just random inflation. It always starts with a real-world supply shock. Remember the Strait of Hormuz disruption. The IEA called it the largest in history, and it pushed U.S. gas up to $4.48. That immediately hits the CPI basket, driving the April print to 3.8% year-over-year, the highest we've seen since May 2023. Core CPI is sitting at 2.8%. From there, that pain bleeds directly into the consumer's brain, pushing year-ahead inflation expectations up to 4.8%. And naturally, that feeds into wage demands and ultimately dictates what the Federal Reserve is forced to do next.
And that leads us to the political layer of this whole chain. Just this morning, newly sworn-in Fed Chair Kevin Warsh claimed he can somehow control inflation and lower benchmark rates at the same time. Meanwhile, at his swearing-in, the president emphasized wanting Warsh to be totally independent, even though we all know the pressure to cut rates is incredibly high right now. And yet, the markets are out there pricing a 40 to 50% chance of a rate hike in December. As neutral observers, we know these competing stories simply cannot all be true. Which one breaks first is a massive, massive question for the market.
Moving right along to signal 2, the yield curve.
This is how serious investors ask the ultimate question: are we heading into a recession in 2027? Professionals use a multi-tiered dashboard to figure this out. Tier 1 is the shape of the 2-year versus 10-year yield. Right now, it's narrow, which is a classic late-cycle signature. Short-term rates are staying stubbornly high while long-term rates creep up. Tier 2 is the 3-month versus 10-year spread. The New York Fed actually uses this for recession probabilities. It briefly flipped positive earlier this year but went negative again recently. But honestly, it's Tier 3 that is absolutely critical right now.
The crucial point is the rate of change. The 10-year yield sits at 4.61%. But the alarming part isn't that level, it's how fast we got there. It rose 40 basis points in a single month. As analyst Kevin Gordon points out, the speed at which yields rise matters so much more for equities than the actual level. If it's a slow climb, equities can absorb it, but a fast climb, equities choke. And right now, all 3 tiers of our yield curve radar are flashing yellow.
That brings us to signal 3, consumer sentiment. Wall Street consistently ignores this one until it's way too late. We already know it printed at an abysmal 44.8, but we really need to understand exactly why it's so low. When folks were asked what was destroying their finances, 57% immediately pointed to high prices. 33% specifically named gasoline, which directly reflects that oil shock we just mapped out. And 30% pointed to tariffs. You guys, this is real, tangible pain felt at the grocery store, and it is completely isolated from Wall Street's all-time highs.
And here's why this is a true radar signal, not just some random vibe check. Historically, this index actually leads consumer spending by about 2 to 3 months. When sentiment drops this far below actual economic activity, one of two things is going to happen. Either sentiment is totally wrong and bounces back up, or real spending follows it down. And historically, sentiment hasn't been wrong in the modern record. In 1980, 2008, and 2020, those dismal readings always led to an actual contraction within months, for sure.
Let's tie all of this together with our final piece of the puzzle, Signal 4, the oil transmission.
So, when U.S. benchmark oil, WTI crude, moves from the 70s up into the hundreds, experienced investors don't just trade the oil. They trace the chain forward. Over a 9 to 12-month period, it unfolds in 4 distinct steps. Link 1, oil prints higher. Link 2, about a quarter later, CPI moves up. Link 3, 2 quarters after that, the Fed is forced to respond. And Link 4, the stock market reprices based on those new interest rates. It's like a giant domino effect. And we actually have the exact math on how Link 1 feeds into Link 2. A recent working paper from the Dallas Federal Reserve explicitly modeled this out. They found that every sustained $20 move in oil adds roughly 80 basis points, or 0.8%, to headline CPI within 2 quarters. That recent 3.8% CPI print we just talked about, it perfectly matches this model. This dynamic forces the market to eventually reprice the entire rate path. Now, with all these warning signs flashing red, the logical thought is to try and time the market, right? Well, that brings us to the trap. Decades of Dalbar studies show a pretty devastating truth. The average retail investor who tries to time these macro events, jumping in and out on Fed signals or yield curve flips, ends up capturing about a 6% annualized return. Meanwhile, just blindly holding the broad index returns 10%. Vanguard's research backs this right up too. Simple, blind monthly purchases into a broad index beat the average active manager by roughly 2% annualized after fees. It's crazy. So why does this happen? Well, that 4% performance gap isn't because retail investors aren't smart enough, it is a behavioral failure. It happens because investors inevitably miss the 10 absolute best trading days in a decade, precisely because those best days relentlessly cluster inside the absolute worst, most volatile months. If you panic and sell based on a radar signal, you miss the explosive rebound. Every single time.
So if the radar isn't for timing, what exactly is it for? It's for tilting instead of timing.
Here's the core difference. Timing the market means selling what you already own, liquidating your existing equity book to hide in cash, and then trying to magically buy back in lower. That is the losing strategy we just laid out. Tilting the portfolio, on the other hand, means leaving your existing investments alone to grow and redirecting your new capital, your marginal dollars, toward what the transmission chain implies.
What does that actually look like in practice? Well, when all 4 of our signals are flashing, you take your monthly contributions, your bonuses, your dividend reinvestments, and you nudge them towards specific areas. Things like commodities, defense exposure, building a cash floor, or inflation-linked bonds. Look, a pure long-duration tech portfolio is essentially short the rate path. But adding commodities and defense, that makes you long the transmission chain. You get to change the shape of your portfolio meaningfully over a year without ever triggering a single capital gains tax event by selling. It's a real game changer.
Because at the end of the day, the entire purpose of having a macro radar isn't to predict the exact day the storm arrives so you can jump off the ship. It's simply to know which way your boat should already be facing when the wind finally hits. I want to leave you with a question to really chew on. We've looked at the inflation chain, the yield curve, consumer sentiment, and the oil transmission. Based on everything we just covered together, which of those 4 signals do you think is the most heavily loaded right now in your read of 2026? I'm super curious, so let me know your thoughts in the comments below. Thanks so much for joining me on this explainer. Keep learning, keep tilting, and I will see you next time.